The latest reading on fourth quarter GDP was released on Friday morning, showing the economy grew 2.2% compared to estimates of 2.4%. For more analysis, let's bring in Emanuella Enenajor, U.S. economist at Bank of America, Merrill Lynch. So, Emanuella, what's your reaction to these numbers? We're slightly below expectations, right?
They were a bit below expectations, and the 2.2% rate of growth essentially matched what we expected kind of going in because of the second revision. This was a third revision. So on the headline, it really wasn't anything surprising. But if you dig down into the details, actually it was not that bad. It was pretty good. We had upward revisions to consumption, we had upward revisions to domestic demand, and we had downward revisions to inventories. So that actually sets up Q1 growth for a bit of a stronger pace potentially.
Right. Now, of course, this doesn't include the cold weather in January and February, but earlier this week, durable goods orders fell 1.4% in February. Now, do you chalk that up to the cold weather, or is there a larger fundamental issue we should be worried about?
Well, shipments weren't really very strong. Orders fell dramatically, and typically during inclement weather periods, shipments get affected. Orders, you can make orders regardless of if it's snowing or raining or hot outside. You just place an order. So it's a bit puzzling that orders were down so dramatically, and I don't know if I chalk that all up to the weather. I do think the weather had an impact on broad manufacturing indicators. But if you look at the trend in durable goods, you had a huge surge in mid-2014. And so I think some of the data is just kind of partly coming off of that. And we're seeing a bit more moderate pace of business capital spending. Still positive, still good, but not quite the kind of blowout pace that we had in mid-2014.
So any consumer spending worries on the horizon in your view?
Well, the data have not been very encouraging on the consumer. I mean, fundamentally, you've got strong hiring, you've got increased confidence, you've got a lot of reasons for the consumer to get out there and spend more, lower gasoline prices, and yet we haven't really seen that filter through into the data. So for now, the data have been disappointing. Looking ahead, I would expect consumer spending to pick up. All of these pieces are in place for a stronger consumer, and we think it just takes a bit of time before consumers respond to the benefits of low gasoline prices. So we're holding out, and we're anticipating that the consumer will pick up in the mid part of this year going into the latter part of 2015.
All right, now how does all this play into the Federal Reserve's looming policy shift? Does any of this data change your outlook for the first rate hike?
Not this data in particular. I mean, you've got to look at the entire spectrum of data. You have to look at what's happening with the currency. I mean, the currency is something that could, the appreciation is something that could kind of put a bit of a headwind on growth, maybe a couple tenths of a percentage point. What's more important is its impact on inflation. If you look at our research, we think that a 20% appreciation in the dollar could weigh on inflation by about 0.5 of a percentage point over the next 4 quarters. So rather than kind of the little quirks in the data itself, I think the dollar is something that the Fed is going to be putting more and more attention on, particularly given how weak inflation is already. It's kind of just kicking inflation when it's already down. So we think the Fed is going to probably hike in September, but keep a very close eye. Downside inflationary risks could cause more caution for the Fed.
All right, now is there anything else investors should be looking at to try and piece together what's going through the minds of central bankers in the coming months?
Absolutely. I think when you look at the Fed, their commentary generally has been from the core FOMC members. They are comfortable potentially with moving on rates at the midpoint of this year or later this year. And one of the key reasons for that is because the job data have been so strong. The inflation data have been disappointing, but the jobs data have been really holding up, and it's kind of putting the Fed on that trajectory towards full employment. So we want to see continued growth in employment, continued solid hiring. That would be consistent with the Fed feeling comfortable with raising rates this year, and I think that's one of the most critical data points to watch going forward.
All right, Emanuella, we'll leave it there. Emanuella Enenajor, U.S. economist at Bank of America, Merrill Lynch. Thanks for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.